And, people say, what's going to break? What's going to break? My view is that in a massively indebted world, to put this in perspective, the US is some 300 and something percent of GDP in debt as total debts to GDP. It is 100% of world GDP in debt. It's the most indebted any nation has ever been. And everybody borrows dollars. And we're in a system where they're trying to act like Paul Volcker, because basically the Fed is run by a bunch of baby boomers and they want to get a book out where they're on the front cover like Paul Volcker to be the heroes. But I think what they're doing is fighting the ghosts of the past. The ghost of the past, the 1970s, was wildly different. We've talked about this in Daily Briefing before. The demographic setup is different. Also, the debt is different. I mean, the US is like 100% of GDP in debt, total debts at that point. We're now at least another 150%, maybe 200% of GDP in debt on top. So with an aging demographic and high debt, it's very difficult to generate inflation. But the Fed are now convinced they need to be Paul Volcker, and they are going to go and raise rates further than the market can deal with. And we're seeing it. We're seeing it everywhere, that the market's going, we cannot deal with rates like this and the liquidity that's happened. But we've just seen the fastest ever rise in real rates in history. So you're raising real rates on people at a time when they can't afford to service their debts because there's too much debt out there. So it's creating chaos in the bond market because the Fed have essentially gone too far with this whole mechanism between how the banks can use their balance sheets, plus quantitative tightening, plus raising the Fed funds rate. And the market's freaking out. So it's decoupled from the fundamentals as well. So the bond market, Claire, if you bring up the next one, which is the ISM and the bond market are tied at the hip normally. Basically, bond yields go down when economic growth is falling because growth and inflation fall. And that's right. What's happened is bonds are pricing an ISM now in the 60s, high 60s, when the ISM in the next month is going to cross 50. So the ISM is going to be pointing to recession, which we all know is happening from almost every single guest we've had on. Yet the bond market is broken. So it's saying the opposite. Now, we've seen a few episodes similar, but this is the furthest it's ever been from the business cycle in bond market history. So it tells you there's a massive dislocation that's going on. That dislocation has spilled through to the currency market as well. We've already been noting, dollar yen, right? That was a specific situation because there was yield curve control, so you're printing yen. Taiwan, they're all seeing massive currency declines. So this is finished goods. This is TVs and computers and chips and all of that stuff. So the US kind of likes it. It also geopolitically, they like it because they exert their power, which is the biggest power they've got is the US dollar. 87% of world trade is in US dollars, even though the US is 25% of GDP. But you're choking the entire system. If we look at the next chart of Asian currencies, this is the ADXY, less looked at than the DXY. It's a basket of Asian currencies. That is breaking a head and shoulders top of a terrifying magnitude. I don't know what this is telling us, but it's telling us that there is no dollar liquidity in all of Asia. And this is a problem. It's a structural problem, not just a cyclical one that's happening now. So the moves that we're seeing in the bond market and the currency market are becoming sort of unprecedented, the sort of unprecedented we saw in March 2020. The knock-on effects are things like mortgage rates are exploding still. So it is a scary situation. But how I look at this is, okay, and I had a great conversation that will come up in next week, I think, with Arthur Hayes from BitMEX. Arthur said, listen, there's two games at play here. One is those guys who want to be Volcker, and they're having their day in the sun. But in the background is a much more powerful group, and that is the politicians. The politicians are the ones that actually set policy. When the politicians decide that economic growth has gone too far, they will change the game. And I believe that. And that's where quantitative easing, direct handouts, and other stuff to alleviate the pain that's going on. They can't have mortgage rates like this for very long before unemployment starts coming and this becomes a big problem for the Biden administration or whichever administration, whichever country you got to deal with. So therefore, the propensity for there to be, if this trend continues that we're seeing, there is a propensity for the market soon to start pricing in somebody's going to have to step in here, much like they did in 2020. So that is still remains my view, is the politicians will end up pushing the Fed around. I think the Fed have created this by fighting the wrong battle, because the battle they remember was the battle that their heroic hero Paul Volcker fought. It ain't that battle. They're fighting the wrong thing. And so we've got a big problem on our hands. But over the next few weeks, as this pushes to its logical conclusion, you can hear in the background the people coming to the rescue. I don't believe that. I think people are projecting what they want, not what is. What is the Fed have got break-even rates of inflation down to the twos, and if this continues for the next few weeks in the vein that it is, and if oil continues to trade towards $60, which I've been saying it's going, these break-even rates are going to come down to 1%. So the battle is won. Now, I actually think, and I've said this before on the show, I think actually inflation is negative in 18 months' time. I think they completely misread the bullwhip. And the bullwhip was post-pandemic, spikes the inflation because everyone comes in the workforce, no supply, overreact to the supply. Yes, they should have raised rates, but not like this. They've misread it. They want to be Volcker. And before they know it, they've destroyed the economy and inflation as well. And they've got their old friend back, deflation.
Mm.
And the only retail that does count in the equity markets are the millennials who are 401k dollar cost averaging. They're not selling.
Mm.
They're not punters. So that flow is slow. But if I look at every single part of the Merrill Lynch survey or the AAII survey or the institutional investor survey, there are all-time record lows, below 2001, below 2008 on every measure. I've never seen anything like it.
We have another question from because I'm going to get right to the questions because this is what we do, right? People are nervous. They've been looking at Twitter, looking at the headlines, looking at the red hours all day. Guns, dogs, and coffee. Do foreign central banks sell to repatriate their U.S. equity positions, aka tech stocks, to fortify local domestic balance sheets? Given QT.
There is a theory that's going around, and I'm not sure. I'm sure that some of it, but I haven't seen wholesale ECB selling US bonds. Are the European banks selling US bonds? I don't know. But there is some sort of doom loop. Andreas Steno Larsen put something out about the doom loop of, if we go back to the 1940s, post World War II, the market was down 22%. 1990, nice big regular recession. ISM went down to 30. Where did the stock market go? Down 20%. Everyone's convinced, talking themselves into being more and more and more and more bearish. There's a probability, and it's probably, for me, it's probably 30%, 30 or 40% that it makes significant lows, but I think it's 60% more likely that we don't make significant new lows. But let's wait and see. These are, the bond market keeps breaking, and we're at 4.5% yields in 3 weeks' time.